Good evening, everyone. Today we have Nilesh Shah, MD of Kotak Asset Management Company. Mr. Nilesh has more than 25 years of experience, and he has been pioneer in picking up a lot of good sectors during his span of time. And he's a co-author of a book, Financial Planning: A Direct Take. And after the session, he'll take Q&A. Q&A will not have stock specific questions. He'll take sector specific questions if there are any. Thank you. Sir, over to you.
Thank you. Wish all the viewers of Kotak Securities a very happy new year. The 2018 calendar year has not been that happy from an investment point of view. In some sense, 2018 represented, for bulk of the time, a perfect storm. This was the movie of George Clooney where a fishing trawler goes into a place where 3-4 storms were raging at the same time. In some sense, Indian economy in bulk of 2018 reached a spot where multiple storms were raging together. Between September 17 to September 18, oil prices moved almost from $55 to $85. Every dollar of oil price going up took $800 million from our pocket. As oil prices spurted up and current account deficit widened, rupee depreciated. From 2013 to 2017, rupee had moved from 68 to 63, but in 2018 it moved from 63 to 74, taking entire appreciation of previous 4 years out. The interest rates went up by 170 basis points to 8.25%. FII became net seller in debt and equity market. The credit event like IL&FS default occurred. And put all these things together, the equity markets corrected. At one point of time, large caps had corrected from Jan 18 high by October 18 by about 12%, mid caps had corrected by about 25%, and small caps had corrected by about 43%. For foreigners, courtesy rupee depreciation, this loss was even higher. This created perfect storm for Indian economy and Indian market. But now I will call Indian economy as Om Shanti Om market. If you remember the movie Om Shanti Om, Shah Rukh Khan makes a dialogue over there which says that अगर आप किसी चीज की दिल से चाहत कर लो तो सारी कायनात जुड़ जाती है आपको उससे मिलाने के लिए. Something similar happened around Diwali time when the nation prayed to Lakshmi Mata for some benefits, some blessings, and suddenly, against all expectations, oil prices corrected. Today oil prices have moved back from $85 to $55. As oil prices corrected, rupee appreciated from 74 to 69. Interest rate came down from 8.25 to 7.5. FIIs who were sellers in September and October became buyer in November and December and hopefully will continue trend in Jan 2019. The IL&FS related default issue is behind us, with IL&FS being superseded and professional staff running it. In some sense, all the negatives which we had suffered for bulk of 2018 now is behind us. There was a song in a movie called Jagruti, हम लाए हैं तूफान से कश्ती निकाल के, इस देश को मेरे बच्चों रखना संभाल के. With some modification, probably market is now saying that इस देश को लाए हम तूफान से, इस देश को लाए हम तूफान से निकाल के, मेरे देश के वोटर इसको संभालना रख के. So now the big event which we are facing is May 2019 general election. If we notice elections, on the day of election results, markets witnessed unusual volatility. Like it happened in May 2004, when against market expectation, the NDA government didn't come to power, UPA government came, and even before they had announced what will be the shape of their economic policy, market came down crashing by 15%. In May 2009, against all expectations, we saw UPA coming back with higher number of seats and markets went up 20%. So on the day of election results, when results are against market expectation, we could see upward circuit or downward circuit in market. However, over the residual tenure of the government, it really doesn't matter what election results are. In May 2004, we witnessed a correction in market on election result day, but thereafter we witnessed one of the biggest rally where Sensex moved from almost 4,000 to 21,000. In May 2009, we witnessed markets going up 20%, but thereafter returns were quite muted. In 2013-14 election scenario, markets got the result what it was expecting, but the bulk of the return was made in anticipation of results rather than after seeing the actual result. In September 2013, BJP announced Mr. Modi as Prime Ministerial candidate, and from there onwards, Sensex started moving from 18,000 and it reached 28,000 by May 2014 when Mr. Modi formed the government. So in some sense, you have to play contra in order to make money. And our guess is that May 2019 is no different. If market is today pricing in stable government and you see probability of stable government happening ahead, then it's time to take some profit out, because in case indeed a stable government comes, then you will not see market rising significantly. But in case there is a Khichdi Sarkar, then markets can correct quite significantly. On the other hand, if due to political uncertainty, market starts discounting a Khichdi Sarkar ahead of election, it will be substantially lower from current level, and that's the time to take risk and put some money, because indeed if Khichdi Sarkar comes, then the correction will be limited because it's already priced in. But in case a stable government comes against expectation, markets could see 20% rise. So playing contra ahead of election is one way to make money, or remaining invested over next 3, 4, 5 years will be another way to make money. And as I mentioned now, in 2019, economy is looking far better than it was looking in 2018. Oil prices are down, interest rates are down, RBI is pumping liquidity, currency has stabilized, economic growth has returned, inflation has come down. Overall economic growth, corporate earnings will be far better than what they were in 2018. The real challenge for us remains election, but the impact will be maximum on the results day. But over the residual tenure of the government, it really wouldn't make much difference. What will be the sectors which will do well? Well, one sector which should do well is related to rural consumption. There has been fair amount of farm loan waivers across many parts of India, and there is already rumor that even central government might announce something similar to farm loan waiver or some sort of assistance to farmers. Clearly, that money transferred into farmers' pocket will result into rural consumption, will result into higher consumption in rural India, and industries which are linked with rural consumption cycle, it could be two-wheelers, it could be FMCG, it could be consumer durables, it could be agriculture-related industry, they all could get supported with that massive package. The second thing which will do well is related to infrastructures and capital goods. The last 4 years we have seen fair amount of slowdown in private sector investment. One, the leverage was very, very high on private sector balance sheet and they were all focused on deleveraging. Second, the lending norms had become very, very tight and hence bogus entrepreneurs were not able to raise loans from the banking system to set up projects. Third, GST and demonetization had created its own uncertainty in the minds of promoters. More importantly, capacity utilization of India Inc. was just about around 70%. Today, capacity utilization has improved to about 74%, and around 80% capacity utilization investments begin. Our feeling is that as capacity utilization starts increasing, many more entrepreneurs will start focusing on capex plan. The interest rates have started coming down. liquidity has started increasing, and hopefully banking system will be more favorable towards giving credit than compared to 2018. So in 2019 post-election, we do see capital expenditure by private sector picking up. It will be across automobiles, cement, building materials, real estate, and obviously infrastructure. And this sector could provide great opportunity because one, over last 3-4 years of turmoil, many weak players have moved out, and the existing players will be able to dictate their margin, their pricing. Another big trend which is coming up, and this is not a 6 month trend or a 12-month trend, but a 5-year, 10-year trend, is the trend of disruption. Every day we are seeing things getting disrupted. Airbnb today globally is world's most valued hotel company, but they don't have a single hotel room. Uber, Ola, they are large aggregator companies for car rentals, but they don't own a single car. So technology is making it possible for disrupting existing way of doing business. In China, Ant Financials have become the largest mutual fund, even though they are not getting distributed via physical channel of distribution. Such kind of disruptions are coming in various sectors of economy, in various businesses, various industries. Any business which is ignoring this impending threat of disruption will become extinct like dinosaur. But those businessmen who will be able to ride on this wave of disruption, they'll create far better value for their investors. So you'll have to invest in companies which are disrupting existing business model, which are creating new products, new services, new solutions, which are cost effective, which are more efficient, and that wave of disruption will result into higher value creation. We are also focused on one more opportunity which is related to US and China tariff war. There are many companies which manufacture product in China for exporting to US. From 1st January, there is a 10% tariff on them imposed by US. And if the trade negotiation between US and China doesn't materialize, then from 1st April, that tariff will go to 25%. That is pushing people to move towards other areas, to other countries for shifting their manufacturing. Footwear is going to Cambodia, computers are going to Taiwan, electronics is going to Thailand and Malaysia, clothing is going to Bangladesh. Clearly, there is great opportunity for India to go and capitalize this. This trend is visible in chemical industry. We have seen India's market share in global chemical trade moving up from 2% to 3%, whereas China is somewhere around 42%. That's the kind of opportunity which is available to Indian entrepreneurs if they can become supplier to US buyers, especially large buyers like Walmart and Amazon, which are present in India but not present in China. This tariff war between US and China creates ample opportunity for Indian manufacturers, right from footwear to clothing to food processing to computers to electronics. This is exactly like what Y2K did to Indian IT industry. We just need entrepreneurs like Azim Premji, Narayan Murthy, Shiv Nadar, Fakir Chand Kohli, who can create large enterprises out of Y2K kind of opportunity for India's manufacturing sector. So overall, if I see 2019 looks far more promising, we are far more optimistic about 2019 than we were for 2018. This is partly happening because oil prices are down, interest rates are down, liquidity is improving, currency is stabilized, inflation is down, IIP is picking up, and government in the run-up to elections will pursue slightly looser fiscal policy. Rural provides great opportunity, especially rural consumption in anticipation of farm loan waiver packages. Infrastructure and capital goods provide opportunity in terms of last 4 years there has not been much investment, and more importantly, as capacity utilization goes up, people will come back to the drawing board on capex. Disruption is a trend not just for 6 months but for next decade or so. If your company is dinosaur kind of attitude, then they'll become extinct. People who are disrupting existing models, they'll create value for shareholders. and the other opportunity is related to US-China tariff war. Companies which will benefit out of that by supplying goods to Americans, I think they will create manufacturing opportunity just like Y2K created IT opportunity. Today, do we look at large cap, mid cap, small cap? From a valuation point of view, in Jan 2018, small caps were trading at 33% to 10-year historical price to book average. Large caps were trading at 10% premium, and mid caps were trading at 25% premium. When I last looked at those numbers, large cap was at 2% premium, small cap was at about 5% discount, and mid caps were at about 10% premium. So from historical premium, we have come down to fair value, and there's not much to choose from. Large caps, mid caps, small caps, all are trading just around their historical average. So at this point of valuation, you should be indifferent between large, mid, and small. All provides exciting opportunities. However, do take a word of caution. In May 2019, if election results are not as per the expectations of the market, then there will be far more volatility in small cap vis-a-vis large cap. Overall, I think it's time to be positive towards markets subject to May 2019 election. Of course, there could be some other factor like oil prices movements or interest rate movements or US dollar moving up and down. But all those will be transient factor. Indian economy is on the way up, corporate earning is improving, and that will hold India pretty well. One final point on India is the increasing participation of domestic investors in equity market. Whole of 2018, FIIs were net sellers, about $4.5 billion in equity, another $4.5 billion to $5 billion in debt. And despite that massive selling, the domestic institutional investors led by mutual funds continued to buy out FIIs. We believe in 2019 FIIs will turn positive to India, and the domestic mutual fund and insurance companies' participation will continue, and this should be able to reduce volatility of Indian equity market significantly. Put all these things together, we think from a risk return point of view, 2019 provides great opportunity. Just be mindful of May 2019, especially for the election result day impact. Over a longer tenure, hopefully all these things will be behind us. Thank you. Happy to take your questions. Again, as I mentioned, I won't be able to give stock specific comment, but one comment is that what shares to buy for rural over next 3-year investment. Well, I can't give you company name, but the theme remains FMCG, which is consumer staples, or consumer discretionary, consumer durables, which is like your white goods and stuff like that, or two-wheelers, and also agriculture related pesticide company, fertilizer company, tractor company, and so on and so forth. The second question is, I'm aged 24, first time to invest. Is it right time to start? And should I be investing for 3, 5, 8, 12 years? Well, it's a very good start at 24 years of age. And when you have money, that's the best time to start, especially when you are investing for long term. And the best way to invest is via systematic investment plan. Don't try to time the market. Just invest into a couple of good stocks which you believe will last for next 10, 15 years. And if not, then you can invest into mutual fund scheme via systematic investment plan. Please don't discontinue your SIP, especially when it is giving negative return, because that's the whole purpose of SIP. It makes you average in the market. It makes you invest at the high as well as low of the market. Just take a 5-year, 10-year horizon on SIP and continue investment in mutual fund schemes or direct stocks. Another one question has come, is the valuation very high even today? The answer is no. Please remember that current profitability is depressed because of higher interest rates, higher real interest rates, a little bit overvalued currency for bulk of 2017 and reasonable part of 2018. And more importantly, a reasonably tight monetary policy which has taken out liquidity from banking system. Going forward, compared to 2017 and 2018, we'll have lower real interest rates, better liquidity, and more fair valued currency. This will result corporate profitability to grow at a faster pace, and of course, it is going to get supported by lower oil prices. Put all these things together, we believe corporate profitability will be growing at a faster pace in the days to come, and that will result into lower and lower valuation. Keeping the faster growth of profitability, we don't think valuations are unreasonable today. It is certainly not as cheap as they were in October 2008 global crisis, but it is at fair value. It's around their 10-year historical average. What's the future of NBFC, and is it time to hold or sell banks? Well, on the NBFC side, we believe it will be now case specific. There are NBFCs where governance practices are world class. There are NBFCs where governance related concerns are there. There are NBFCs where liability franchise, their ability to raise debt is much more diversified through retail deposits, corporate deposits, capital market instruments like CP, CD, debenture, ECB, masala bonds, bank loans, refinancing from regulators. There are some NBFCs whose exposure to one set of financing, wise bank or capital market, is disproportionately high. There is one NBFC where the recognition in terms of NPAs is at par with banking system. There's one set of NBFCs where recognition of NPAs due to variety of off-balance sheet exposure is not up to date as per the market expectation. Clearly, market will divide between these two sets of NBFCs. NBFCs where governance practices are good, where their perceived rating and actual rating is same, where the liability franchise is well diversified, and where NPAs are measured correctly. I think those NBFCs are a great investment opportunity. They have moved out of trouble and they'll continue to do well in the days to come. But there are few NBFCs where governance practices are debatable. NPAs are probably evergreen through off-balance sheet exposures. The liability franchise is not diversified. It is heavily dependent upon one source. And this kind of NBFCs will find it difficult to go back to their original highs. Probably exiting those NBFCs in favor of other set of NBFCs will be far more appropriate. Do you see value in PSU banks now on? Well, PSU banks is always very, very difficult to take a call on. We treat PSU bank more as a trading opportunity, not from a day-to-day trading point of view, but from a medium-term point of view. Let me first focus on the challenges which PSU bank is facing and then come to their positives. The one big challenge which PSU bank is facing is that bulk of their senior management will retire over next couple of years. They don't have very large middle management, and then they don't do lateral recruitment. They of course have a fairly large base of lower level management. So in absence of a strong middle management who will come up to take a burden from the retiring senior management, the quality of management in PSU banks could come under pressure. The second thing is related to that compensation of this management. You all know the senior management of PSU bank is paid much, much lower compared to their private sector counterpart. So how do you attract talent at lower salary to run PSU bank is another question. The third thing is related to administrative convenience. What can be done in one day in private sector banks because of the procedural issues requires probably 1 month in PSU bank. How do you create that administrative flexibility so that they can be more market oriented, they can be more customer facing? These are all the challenges which is restricting public sector bank. In the near term, expectations of PSU bank is much lower. The government is going to capitalize them well enough to capture the growth opportunity. The liability franchise has remained reasonably well, and the NPA cycle is turning around as per RBI. Put all these things together, PSU banks will become trading opportunity. In a very, very lighter vein, you have to buy PSU banks when they are very, very cheap and sell when they are cheap. Don't buy them when they are just cheap. Your view on the current bond yield volatility? Well, the bond yields are function of RBI's monetary policy announcement. and also of the demand and supply. In the first half of 2017, bond yields kept on rising. In fact, in first 9 months of 2018, bond yields kept on rising primarily because oil prices were high, inflationary expectation was building up, and the government had a massive borrowing program. Post September 2000, October 2018, the bond yield started correcting as one RBI conducted open market operations to provide to take out some of the government's borrowing program and provide liquidity to the banking system. Oil prices came down, agriculture inflation remained under control, and the overall inflation number consistently came below RBI's comfort zone. This resulted into a run in the bond yields, and they declined from 8.25 all the way to 7.25 before climbing back to 7.5. We believe from here onwards the volatility in bond yields will be coming down dramatically, subject to obviously inflation and RBI's OMO. But assuming that RBI's OMO will continue up till March 2019 and oil prices will hover around current level, which will give a lot of comfort on the inflation side, bond yields should range between 7.25 on one side and probably 7.5, 7.75 on the other side. On the day government announces big farm loan waiver kind of package, yields could see a little bit of spike up, but that will be great opportunity to invest into the bond yields. Your view on capital goods segment? Well, as I mentioned earlier, capital goods segment looks very, very promising. The banking liquidity is improving. Banks will give more credit. Real interest rates have come down. Capacity utilization has started inching up. Put all these things together, entrepreneurs will start on capital expansion, on capital expenditure post-election, and that will bode well for the capital goods segments. Within capital goods segments, many big players have shut their shop, so the existing guys will be able to set their prices, they'll be able to grow their margin, and which is why we see capital goods having good days in the days to come. Your view on the airline industry stocks? Well, I really don't have a positive view on airline industry. This is one industry where we haven't seen pricing power. There are now huge amount of growth. For last 40 or 45 months, consistently air passenger growth is more than 10%. Oil prices have also come down dramatically, and aviation turbine fuel is lower than the petrol cost. And despite that, airline stocks are not soaring, and that's mainly because of pricing power. Unless until airline gets the pricing power, it will be difficult to be bullish on this sector. Can this happen overnight? Who knows? But certainly we need some sort of pricing discipline among airline players, and then only one can take a call on the airline sector. There's one investor who said that I want to invest per month 1,50,000 and my vision is of 8 months for my marriage. And my recommendation is that please don't invest this money in equity market or equity mutual funds or stocks. You don't invest with 8-month horizon in equity market, especially when you have a occasion like marriage after 8 months, and you also have May 2019 general election. My recommendation will be to put this money into a short-term bond fund or ultra short-term bond fund, where you can be reasonably sure about return of your principal as well as some positive return. So please don't take risk on your marriage in equity market. For 8-month horizon, fixed income is more appropriate product. What is the total loan disbursement by banks in last year? Well, I wouldn't remember exact number, but the current banking loan growth is roughly about 14-15%, which is one of the highest in last 5-6 years. One interesting phenomena which has happened is that last year, FY 2018, one-third of credit disbursed was from private banks, one-third of credit disbursed was from PSU banks, and one-third credit disbursed was from NBFCs. The non-banking financial services sector has moved up significantly to provide credit to the Indian economy, and this trend is likely to accelerate in the days to come. We will see credit need of the economy getting satisfied by PSU banks, by private sector banks and by NBFCs almost in similar range, and over a longer period of time NBFCs and private sector banks will move ahead of PSU banks for satisfying the need of the India Inc. Uh, what do you think of the union budget this time? Well, I believe on 1st February union budget will result into fiscal deficit exceeding little bit of the budgeted estimate. The finance minister has been reassuring market that they will maintain fiscal deficit, but because of some slowdown in GST collection, which has primarily occurred because a lot of items have been moved from 28% bracket to 18% bracket, this has resulted into some drop in GST collections, which will be eventually reflected into fiscal deficit. Our call is that fiscal deficit instead of 3.3% will be about 3.5%. And this budget will be more focused on rural, more focused on infrastructure, more focused on Aam Aadmi. The narrative will be towards rural, Aam Aadmi, and infrastructure. What will be the effect of trade war between US and China? As I explained earlier, this is Y2K kind of opportunity for India's manufacturing sector. By capturing Y2K opportunity today, we have created $100 billion market cap TCS or $30-40 billion market cap Infosys and Wipro and so on and so forth. What we missed out in 1980s was to become manufacturer to the world like China. The same opportunity is coming back to us because of the tariff imposed by US on Chinese exports. If we can convince large buyers like Amazon and Walmart to source their goods from Indian manufacturers rather than Chinese manufacturers, that could result into development of India's manufacturing base, and that could result into far higher growth in Indian economy, and we can create far many jobs in manufacturing sector than what we have created in the past by capturing this US-China tariff war. US and China and India can be best explained by Aesop's fable, where there were two cats which were fighting over a piece of bread, and then a monkey came and he tried to mediate it between those two cats and took the entire piece of bread. US and China are fighting with each other. We should protect our selfish interests and try to take advantage of the situation by shifting manufacturers from China to India and exporting goods to America.
We'll take last two questions now.
The last two question, view on real estate sector in coming years. Well, we believe real estate sector is at an interesting opportunity. In the listed space, there are very few listed real estate players, and many of them have governance related issues. But we believe now real estate is bottoming out across the country, and hopefully in 2019 and 2020, there will be better days for real estate sector. Our focus will be more on playing real estate via building materials, tiles, pipes, fittings, kind of ancillary sector, rather than buying into real estate per se. The final question is, what will be the impact of elections on the market? Well, as I mentioned earlier, election results, if they are not in line with expectations of the market, could always result into a big movement in market up or down. But over the residual tenure of the government, elections don't really matter. What matters is how the economy is run. Today, Indian market is priced in a stable government, which means there will be one party and they will form the coalition, but one party will be running as a pivot. If that government continue to pursue economic policies and growth, then markets will be supported. What market is not factored in is a government which won't be committed to economic reforms and growth, a government which will be more focused on populist measures rather than taking long-term steps to push India into higher growth orbit. If we get a stable government, then from here onwards 2019 is looking far better poised than what was 2018. Thank you.